Hello and welcome to the Morningstar series Market Reaction. I'm Emma Wall and I'm joined today by State Street's Tim Graf to talk about the UK economy. Hello, Tim.
Good morning.
So we've had some data this week, PMI data, which suggests that the UK economy is not perhaps as robust as we might like it. How should we interpret these kind of data?
I think we should interpret it as being another sluggish Q3, or another sluggish quarter, I should say, continuing on the sluggish performance of Q1 and Q2. So it's going to make it very difficult for the growth forecast of the Bank of England to be met if this data is sustained in the hard economic data for Q3, which I think is a real challenge given they're talking about rate hikes coming up.
And are we just being too pessimistic? Because if we cast our minds back a year ago, we were very much expecting to be in recession by now. The Brexit referendum had happened. You know, the negative Nancys of this world thought that we would be, you know, with a crashing market and a recession. And that's not the case. We do still have positive growth. So should we be worried?
I think so, because a lot of that growth has come off the back of a very resilient UK consumer who's been able to sustain demand largely through the growth in consumer credit. Credit levels aren't worrying yet, but they might well be, particularly if interest rates are to start rising. So I think even though we've done a lot better than a lot of forecasts going into the Brexit vote, that is maybe, I think, missing some of the broader picture, which is that the UK economy is still somewhat fragile and very dependent on easy monetary conditions, I think.
And of course, if interest rates rise, that will hit households. It'll hit them in terms of mortgages, in loans, in credit cards. What about in terms of their investments? How does, rising rates and a sluggish economy impact portfolios?
I think it's going to still be very difficult. I mean, we've heard about how rate rises will be decent for savers, but we're not talking about long-term programmatic rises in interest rates. We're talking about maybe 25, 50 basis points. So savers won't necessarily be helped that much, particularly given how high inflation is. So I think fixed income investing in the UK, particularly for domestic investors, remains very, very challenging. Real rates, especially long-term real rates, are likely to remain negative for a good period of time. The equity markets actually might fare a little bit better because I think sterling will probably remain weak for some time. Given how much of the FTSE is internationally focused, that will probably be to the benefit of corporate earnings for the big large cap UK companies. Small caps may fare a little bit more difficult.
And of course, we are having this economic, the stilted economic growth because there is uncertainty in the market. Should we then expect the economic growth to remain at these kind of levels or even dip, given so much of Brexit is still uncertain?
I think these kind of levels are probably the baseline scenario. I don't think there's going to be a disaster coming up, that we have about as much political uncertainty as you can fathom right now in the UK economy to deal with. And the UK economy is dealing with it, albeit in quite stagnant fashion. So I wouldn't necessarily look for a downturn from here, but I think relative to the rest of the world, we're having this pickup in growth in almost synchronized fashion around the world, and it's not really happening here. So I think it will continue to lose ground on a relative basis, even if in absolute terms it probably fares okay.
Tim, thank you very much.
Thank you.
This is Emma Wall from Morningstar. Thank you for watching.